All right, good morning, everyone. This is John with the planning and scanning for the week beginning October 21st. Today we have the Energy Department coming out at 9:30 with their report that should have been out last week. More importantly, this week we have just a slew of earnings and an incredible barrage of numbers as the government got back to work, so to speak. Not that they were really out of work. It was kind of like I don't know. I don't want to give a statement on why some agencies would have been shut down and others not, but regardless, it is what it is, and we'll move on. Unemployment for the month that would have been out on Friday, the 4th of October, will come out tomorrow morning. That's Tuesday, the 22nd, so be aware of that. And with all these reports that are coming out, I think now we can kind of focus in on the real issue, the strength or weakness of the economy. You know, the rumors or the concept of sequestration was going to slow the economy down, and yet here we are with the equity markets making new highs with the Federal Reserve, and the quandary is when will they stop or ease on their quantitative easing, particularly their buying of treasuries at $85 billion per month, which, as you know, suppresses interest rates, which is keeps our interest rates artificially low, which is an injection of liquidity in the banking system, et cetera, which is what the stock market is feeding off of. But as you can see from my relative strength analysis here, the one sector that is really gaining the most, and not all sectors are created equally, this black represents the NASDAQ. So the technology sector has really outperformed you know, the broad range of markets. So with that said, what I wanted to take a further look at, if I may, is take a look at with you a little bit longer to find out where we should be maybe focusing on. In the last few weeks, we've done, I think in this trading room, we've actually done, I don't know, you guys are the judges, not me, but in my mind, I look at my statements and I know we did some pretty neat things with starting with the price line credit call spreads when we picked out that high with monthly resistance at 1070. And I know we've done pretty well in identifying the technology space several weeks ago. Last week's message was the same message as the prior week, to stick with those tech names. I know there's a misprint on our tweets, but Microsoft, we were talking about doing credit put spreads with the alert at 33.30. Microsoft's over 35.08 now. So I think there's been a lot of really good analysis out there for you guys by using what we teach here at Trading Triggers. It's a matter of is it being applied correctly? And I think as the more you see how technical analysis used in the proper content can help us to search for opportunities, it's a matter of being able to apply a strategy, and what defines the strategy is your tolerance for risk. I mean, that's really the essence of what a trade is. So if you want to be outright with an aggressive position, the more aggressive your position, the higher the risk factor. End of story. So with that said, I think that we come in here every week and try to look for stocks and try to look for overall market performance. Last week we came in here and gave a trade-off in identifying live cattle. I mean, we had that teed up, set up perfectly. And granted, I'm not going to say that most of you guys, ladies and gentlemen, are interested in trading live cattle, but I mean, it had about a 90% rate of return in about 2 hours or less on its initial margin requirement, which was a heck of a move if you had at least caught some of it. But in any event, it was the idea that we saw the seasonal analysis. We were looking for a move up at resistance, number 2. Number 3, we identified that the uptrend was on very weak volume. And number 4, we also used the Commitment of Traders report, which revealed that only the hedge funds were actually net long the market. And whereas small speculators, which typically are not the group to pay attention to, but in live cattle it is, because a lot of small farmers, ranchers, do not open up bigger hedge accounts. They just hedge their small operations with an option in their personal private little trading accounts. And so therefore, you know, it's not one that you really use the Commitment of Traders report to gauge the small speculators against commercials. So sometimes the small speculators are the commercials in the sense that they're hedging their beef production on small ranches and small feedlot operations. So with that said, it's the hedge funds, these guys on Wall Street. That was I think that was my exact words. I said, these guys on Wall Street, these hedge fund managers, they have their system straighter. They have no clue what a cow looks like other than filet mignon at the restaurant. So other than that, we were looking for a downturn in cattle. We announced, look for that 60-minute turn. You got a 60-minute PPS signal. So I think the trading room has been effective. But again, you guys have to be the judge of that. And what we're trying to do in planning and scanning each and every week is to identify the markets based on testifiable evidence and then to look for trading opportunities around that. So when I come in here and I look at, like, for example, the charts that I've created in my Genesis package, and I look at my relative strengths and I look at my different sectors, and this might seem like a lot of lines, and for those that don't know what they are, I'll go through it real quick. This is just a listing, and we start at a particular starting point. In this case, we have the starting point from, we're going to go back to the beginning of September. So as you can see, this is August 30th, and what each color represents, this is a 0 line. So this is the starting point of that time, and we look at the performance of the different sectors. Black are the spiders. So, I mean, think of it this way. In the S&P 500, or excuse me, this particular black, let me double check that. I apologize. I think that's emerging markets. Let me double check something here. Yes, okay. So this is emerging markets, and emerging markets in September have gone from negative or just under 0% to over a 13% gain. And that seems like incredible. The only problem is the emerging markets from year to date is still negative about 4% year to date. So it was down approximately 18% at one point back in June. So emerging markets may look like a good investment opportunity, but it's still underwater for the year. And when we take a look at the percentage performance in what sectors, the internet, this is this brown right here, and this is what we were kind of focusing in on since, in fact, I did a big presentation, and I think, not to throw anyone under the bus, but I think Ruth, one of our students, was at the options event that we were invited to speak at the Chicago Options Conference, and I focused in on the internet, the IIX, the internet ETF, and the holdings within there, saying from a seasonal perspective, this is the one that starts to kick into high gear. With that information, I came in that following Monday, and we gave you guys this in planning and scanning, and I'm sure those videos are still available, so you can go and review. And as you can see, it's actually from all the sectors that we're looking at, the IIX compared to the transportation sector, which is in second place, the KRE, which is the banking sector of regional banks, the S&P, the XLB, which is material, E is energy, F is financial, I is industrials, K technology, which is a mixed diversified bag. It's not a specified subsector, but all of these sectors are just a mixed diversified ETF that represents the group of that space. So you have consumer staples, utilities, healthcare, consumer discretionary, and I threw in the EEM because there's a lot of fund managers that had invested in. And as you probably, if you think back, I've got a photo. I should put this up on one of my presentations one day. It's on my iPhone. It was in March. It was on my birthday, March 19th to be exact. We were in Paris at the Technical Analysis Conference, and we were coming back, and at the airport, you know those Hudson Bay little stands that you buy your books and magazines and chips and gum and candy and stuff, there were two publications side by side. One was Barron's and one was Financial Times. Barron's more prone to discussing and covering U.S. equity markets, Financial Times more European. On the cover of the Barron's was how to invest in emerging markets, and then right next to it, the paper directly next to it, which I found to be ironic, Financial Times says emerging markets, Syria, all these Turkey having problems. One newspaper is telling you they got problems, and the other newspaper telling you how to take advantage of buying in emerging markets. So it was quite an interesting, it was a dichotomy, and just to see how things have panned out. You know, I guess I'm not reading into saying that buying something on the front cover of Barron's is bad luck, but I'm just pointing out in that particular case, it pays to do your homework because there were two different articles with two different points of view. And of course, emerging markets just got crushed this year. And so even though they're up 13% since the beginning of September, since the beginning of the year, they're still negative on the year. So this is going to play a part of a lot of fund managers right now because at the end of the day, let's go with the S&P 500 up about 20% year to date. 20% year to date, and this thing's down 4% year to date. So if you have your money invested with a 401k, or if you have your money invested with a fund manager, if your money is invested and they're managing your money and they threw all their eggs in one basket or a majority of it in cash in emerging markets, you're down on the year, plus you still got to pay these clowns 1 or 2% management fee, believe it or not. So as you discover, if the stock market moves up and stays at about 20% year to date and you're down 4%, you're actually out almost 25% float of swing of equity. So a lot of people are going to be opening up their statements at the end of this year and saying, what the hell happened? And there's going to be a big shift. So right now, fund managers are scratching their heads. Those that are short bought the market, that are not in, they're in cash, they're praying, they're looking for opportunities. So the question begs, what's the next opportunity? We've kind of nailed some certain opportunities and been having our finger on the pulse of the market, I think. And once again, you guys have to be the judge of that. And I think that right now we have a lot of earnings out this week, and what I wanted to get into is some of the sectors and areas that I think might see some performance. Now, when I take a look at this strawberry or watermelon color down here, and it's only up 3% from the beginning, remember, it was negative. This is utilities, the utility space, and I think there's an opportunity in utilities as we change weather patterns and as we change electrical needs and so forth and so on. Consumer staples, the XLP. We want to start taking a look at consumer staples, and I think that is an area that we can start to focus in on, because during the holidays we're going to start to look at, you know, what's the current trend of consumers? Are the consumers going to be buying iPads, iPhones, TVs, or are consumers going to be buying apparel? What is going to be the trend or the demand for consumers? Or is it going to be kind of necessary? Is it going to be a scaled back Christmas, so to speak, meaning back to basics? These are the questions that I'm kind of asking myself. And if you think about it, in last night's videos for National Futures, I think I got my calendar out, and I think I got it right. We got, I think, less than, 50 trading days to the rest of the year. If you think about that, there might be 48 due to the fact that I'm older and I forgot the number. I should have written it down, but I didn't. But I think it's 50 trading days minus, maybe it's 48 if you take Thanksgiving and Christmas out of the picture. 48 days to catch up to the market. That's what we got left. 48 trading days to make every trading day count. Take a day off. I'm going to be in Toronto this week, so if you guys are up at the Toronto Money Show, I look forward to seeing everyone there who's going to be there. In the meantime, we got 48 days to look for trading opportunities to conclude this year. If you've had a good year, and I've had a pretty good year, hopefully you've had a pretty good year, especially in some of our stock picks, I'm thinking you're going to probably want to scale back. But if you want to get aggressive, and I think now's the time to think about this carefully, a fund that's short bought that needs to get into the market, they're probably going to not want to chase the technology space. They're probably going to not want to chase that growth. They're probably going to want to chase maybe something that's a little bit safer. And with that said, I got a few picks for us. All right. So let's get into what I think might be a decent return, or at least an safe from a risk-reward perspective, okay? Now, what I want to take a look at real quick is I want to show STX. I'm going to show a couple names, and I want you to say to yourself, if you were going to be a buyer, now some of these lines, this is Seagate, STX. These lines are here. If they're in here, it's because we've talked about them at Planning and Scanning, but this is STX. This is WDC. Now, I remember asking and doing a thing on Western Digital, and someone in this room said, yeah, they make crappy hard drives. Well, for a company that makes crappy hard drives, they sure have come out of the box and exploded to the upside. Lousy, as I think what the individual said. I'm not just don't know who it was, but someone did say that. I just went, okay, well, I'm looking at a stock, and I look at the seasonality of this sector bottoming out. I'm looking at this market in here with the volume, and it looked pretty good. So when we take a look at this space, right, we've got Seagate off to the races, Western Digital off to the races, SNDK, SanDisk looks, I mean, it's brutally outrageous. Who in their right mind is going to chase that market, right? If anything, I'd be looking at banking some profit, wouldn't you? I mean, after all, if this stock has had that type of an explosive move, look at this company. So if you look at this came out with earnings on this last week, and it just gapped higher and came right back. And the volume is incredible. And this is a time period where it begins its seasonal strength. I can't even imagine what this thing's going to do. But I would imagine that somehow it's going to eventually come back and test that $40. This is EFII. I just want to also show you this week, NTAP. Now, NTAP has earnings. Excuse me, I'm going to just put this on pause briefly. A cough. All right, so NTAP, computer storage hardware. This space generated a long leg doji last week. It enters a seasonally strong period of time. It doesn't have great volume on a weekly or a daily mark, but you'd want to probably look for NTAP, which NTAP does not have, NetTap does not have earnings until November 13th. I would look for this high, which is approximately, let's call it 42. I'd want to see that market clear 42 and get some volume going into it before I'd look at buying NTAP, by the way. All right, but it is in the same space. We take a look at LXK, Lexmark. Lexmark has earnings tomorrow on 10/22. So the problem that we have is here's a stock that has a weekly high close doji. It pulled back last week, the week before, and then moved up on pretty good volume, and it's in a seasonally strong period of time. So here's a nice little rounding bottom, and I think what's holding back the market at this point in time is simply the fact that it has earnings out. LXK, that's Lexmark. They have earnings out tomorrow, like I said. The next stock, BRCM, Broadcom, JDS. I mean, these patterns all look like they've had some major basing action. So from the deal with Broadcom, it also has earnings out tomorrow on the 22nd. So we've seen how earnings have gone with Google and IBM. I mean, one's good, one's bad. It's a hit or miss. So I don't like to generally take a stock trade in front of earnings. In fact, if I've got a lead in a trade, I'll take something off the table because, I mean, it's one of those artificial moves. It's going to have an accelerated, an exaggerated move, and with all this release of news reports, if you've had a great year, there's no reason to press it. But I'm personally thinking, guys and girls, that this sector is very still. It's very hot, and I'm just digging for some trades in stocks that haven't moved yet, that are entering their seasonally strong period of time, that still have good business models. So the names that I'm putting out there that I want you guys to focus in on, and unfortunately, they have earnings. So Lexmark, Broadcom, they have earnings tomorrow. Let's kind of watch this over today or tomorrow after earnings. The next company is AT&T in telecommunications, Verizon and AT&T. And I'm going to tell you something. We have earnings there on Wednesday, 10/23. These long shadows are very ominous, especially since we have a huge volume breakout. I mean, they have been accumulating long positions here. So this might be a fairly decent trade based on the fact that there's some safety underneath this low. There's been a lot of buying in AT&T under there. We did get a high close doji and a weekly buy signal last week, Friday. So I'm bringing AT&T to the mix here. When we take a look at the space from AT&T, we want to take a look at, of course, Verizon. And Verizon had earnings which were, I don't know, I'd say pretty good, wouldn't you? And volume was pretty huge here. So, I mean, is this one of those situations where Verizon makes good and AT&T doesn't? I don't have the answer to that, but I can tell you what the seasonality of the market is to go up this time of year. The volume action has been very good. Volume was very good before earnings came out. They were accumulating positions down in here. And I'd have to say that this is a stock as a benchmark that any pullbacks in the next, I don't say 2-3 weeks, might be a catalyst to be a buyer in this space. It would also possibly be a situation where the entire space, including AT&T, might give some opportunity for some risk capital traders, guys that are ahead of the game. You may want to take a look at some light long positions ahead of earnings on AT&T. I'm not sure that I'm probably pretty sure the cat's out of bag on that one. We have to do some more homework and look at the implied volatility to see where the options are on AT&T. However, I wanted to take a look at also healthcare, because healthcare facilities, it's a specific sector, okay? So for stock trading, let's take a look at KND real quick. So KND is Kindred Healthcare. This is a stock that, you know, I'm thinking we're going to probably like to see that if we enter in a seasonal time frame for this market. There's a huge gap below here. We're at resistance. I'd like to see this market pull back. It has earnings on 10/28, and this is a space that, to be truthful, hasn't really seen a lot of upside, and it has a lot of upside potential. So what I'm bringing to your attention is, if I was a fund manager and I'm looking for opportunity, I'm going to be not buying SanDisk, Seagate, or Western Digital. They've exploded. I'm going to be looking for maybe some like-kind markets that are in that space that haven't moved, and perhaps get some money to work in those sectors quickly before the rest of the world sees it. So that's why I think it's important to look at Lexmark, LXK, Broadcom, and AT&T because of that reason. I also think that in the XLV, which is a seasonal time frame for strength, but it's not just the pharmaceutical, but it's also healthcare facilities. It's now winter time. People are starting to get aged. They're starting to move south for the winter, so to speak. And it's that year where people were starting, remember, they were starting to build these facilities a couple years ago, and now they're starting to fill in. And I would say it's the seniors 55 centers, believe it or not, are very popular. And also looking at other healthcare facilities, like, for example, here's another one that this stock really, it has had a no-brainer type of move. It had this huge move, and as you can see, it has these huge gaps in the market, and all of a sudden it just doesn't do anything. And what we're seeing right now, by the way, this is Health Management Associates. Excuse me, let me cough. This is one, earnings comes out today, and we want to kind of keep an eye after this one. It's probably under everyone's radar screen, but the reason I'm bringing it to your attention is this might be a sleeper for the next few months, and it's a low equity trade. It had a nice weekly buy. It's had a pretty substantial move, and as you can see, a pretty decent pullback. I'm not impressed with the weekly volume, but what I am impressed with is the seasonality that we're entering. So the stock hasn't done anything because it's in a weak seasonal period, but now it's starting to be picked up. Look at the volume on a daily chart. Market's not going anywhere, and volume's picking up on a daily chart. So this is HMA. This is one I think is a very low risk. Let's wait till earnings come out. HMA should be on your radar screen, and we'll take a look at this one as well. So the last but not least in this space, ESC, looking for some opportunities here for you guys. Here's another one that generated a weekly buy. It has a little lag of seasonality, which bottoms in, it's got a few more weeks, but what I'm thinking is from a risk-reward perspective, I mean, it's a $20 stock, and it was at one point of almost a $31 stock, right? And we've got a weekly buy signal, and we've got a huge pop in weekly volume, which is kind of healthy. So we might get an opportunity to buy this stock as well, ESC, in that space. So there's a couple spaces that we're looking at. The healthcare facilities, three names come to mind: HMA, KND, ESC. So I'll type those in. You guys can do a little bit of homework in that. ESC, and I know this isn't sexy, and I know this isn't looking at LinkedIn and it's not, so this is healthcare facilities. And I don't know, this isn't Tesla and the big momentum names, right? But those big momentum names come with big risk. As far as tech names to watch is LXK, BRCM, and T. I guess you could also add NTAP as well, all right? So I think that those names, those are the names that I think we can kind of focus in on this week for some intermediate term stuff. I also wanted to show something to you real quick. Why do we kind of focus in on planning and scanning on a lot of this stuff? Because I mean, we do run scans, and I can't, you know, we can't sit there and say, hey, here's a sector, by the way, ADP, looking at the seasonalities of the marketplace, and we can scan and look for buy signals at monthly support. And here's why you guys got to do this on your own and follow kind of the rules of what we're teaching, because you can't pick this up every single day. But here is a real easy one. If you guys could run scans at the end of the day, and it's not that hard, you look for seasonally strong stocks and scan for daily high closed dojis. This is ADP. Gave a high closed doji on October 10th, all right? So if you had the capability of scanning for stocks for high closed dojis, and that's what we created this software for, and not many people know how to use it. You guys, we're trying to train you guys to use this, but you can start to scan for trading opportunities. You get nice volume associated. I mean, this is everything that we've been kind of focusing over, right? If you notice that you get a big breakout, a high closed doji, and it comes on decent volume, this is the same day that the overall market formed that high closed doji that we were like warning about a week ago Thursday. And so, I mean, it's not a great move, but it's a move that keeps you on the right side of the market. You know, here's another one. And I feel bad about missing this, but for you guys. But here's one. This is Google. Google formed a high closed doji at monthly support, and it gave a PPS buy signal. So if you guys are scanning, and again, this is not the end of the week. Planning and scanning is at the beginning of the week, and I can't do this stuff intra-week with you guys and be there every minute. What we're supposed to do is train you guys so that you could learn how to do this on your own. But I think overall, to find out if we're looking at the internet space and if Google's in the IIX, which it is, seasonally it has a bullish bias. Now I know there's earnings coming out, but perhaps there is, and this one escaped, I think, a lot of people. No one saw a 12% move or 15% move from this buy signal in Google. But what I will tell you is that when you get daily buy signals or daily high closed doji at monthly support in a seasonally strong period of time, if you can run your own scans on that and focus on that, I think you're going to come up with better stock selections. End of story. So I think for what we got this week, me personally, with our stocks that we have in some of the names like Cirrus and Netgear, earnings are coming out, and even Lolard, as many of you know, I've been pumping the electric vapor cigarettes. We've had big moves there. We got earnings there. I'll probably step out of that picture, seeing on how the market actually opens up. So with that said, we are open. I gave you a couple areas that we could start to look at for this week. I think that we may have overstayed our welcome in technology, believe it or not. And with that said, the market from a AD perspective, remember on the Qs, we are at monthly pivot resistance. On the nice NASDAQ composite, we are at just over monthly pivot resistance. Our longer term monthly monthly pivot resistance, not easy for me. We did break out to new highs on the AD line, but it was very light volume, mainly because probably people are scared of this market and they may have used options instead, okay? But the on-balance volume is showing that this trend is not a sustainable trend, not unless we get a breakout of volume. I'm a little concerned that diamonds, still the laggard, and looking at the NYSE, I think that's where, if I was looking for opportunities, the NYSE did break out on a daily basis and confirm this move. So there's still some value. I think there's people that need to get into the market, and they're going to be looking for low-risk trades. And as I pointed out, I think we got a couple of them in there. Unfortunately, Lexmark and Broadcom and AT&T all have earnings this week. I want you to be aware of that. And, of course, with the healthcare facilities like Kindred, ESC, and HMA, I think there's some good value there for some longer-term growth going into the next 60 days. So that's, to me, longer-term, 60 days. So with that said, that concludes our session today. I just wanted to go over the overall market, where we've been, what we've done, what to look forward to, and what sectors might provide us some decent low-risk opportunities. Because right now, the pickings are getting kind of slim, but I think we found a few for you guys. Be good. Have a great week, and I'll see everyone. If you're going to be up in Toronto, I'll see you guys up there this week. Take care now.